Hi, it's Mitch at Reverse Mortgage Pros. In this video, I want to talk to you about 1% reverse mortgage interest rates and why something like this might not be as good as it seems. Let's get started. Now, if you want free professional help with your reverse mortgage decision, make sure and subscribe to my YouTube channel. You can hit the subscribe button below this video. This video is exclusive to the YouTube channel, so you won't find it anywhere else. So if you want to get videos like this with important information, make sure you're subscribed. Make sure to hit the like button so you get all the videos I release in future to help you understand reverse mortgages and make an informed and educated decision. So it's very easy to get fooled with a reverse mortgage into picking a lender that has the lowest rate at the time to take out. And this applies actually to any mortgage. But for reverse mortgages in particular, renewal rates are more important, much more important than with regular mortgages. And it's very easy for lenders to potentially use renewal rates as another hidden cost with which to hit you up for more money down the line. In this video, I'm going to explain all of that. I'm going to explain that in detail, and I'm going to use the fake example of a 1% reverse mortgage interest rate, show you why that might not be as good as it seems, and give you real life numbers, real life examples to help you understand the importance of renewal rates so you can factor these into your decision and make sure that you're getting a lender that has the renewal rates and premiums that you're looking for. Before I get started, as I usually do, I'm going to quickly, briefly walk you through what is a reverse mortgage in 20 seconds. It's a mortgage for homeowners 55 and over that doesn't require any repayment. Instead, the interest is added to the balance owed. You can get 10 to 55% of the home value depending on your age, property type, and location. You can take as much money as you want, but you must pay off any existing mortgage from the funds first. It's designed to help you tap into your home equity for retirement and continue to live in your home forever. So in this video, I'm going to walk you through hidden reverse mortgage costs at renewal and why a 1% interest rate might not be a good thing if that wasn't something that you're offered. So let's say you happen to be offered a 1% rate on a reverse mortgage, you'd be silly not to take it, right? Well, unfortunately, many folks make this mistake. They look at only the upfront initial rate being offered by a lender to make their decision, which can lead to large hidden costs in future. And what I want to talk to you in particular is about renewal rates. So for reverse mortgages, renewal rates are, in my opinion, more important than the upfront rate you receive. And I'll explain what they are. Renewal rates are what you pay at the end of the 1, 2, 3, 4, or 5 year term that you initially get for your reverse mortgage. You might get a 5 year fixed rate term. At the end of that 5 years, you get renewed onto a new rate. You might get a 2 year fixed rate term. At the end of those 2 years, you get renewed onto a different rate and so on. And I'll give you a couple of charts to help to explain that. And what happens is that many lenders offer premiums on the renewal rate. And so I'm going to explore these and other aspects and show you why you need to be aware of this and why renewal rates are actually more important than the upfront interest rate you're going to pay at the start. So let me just kind of explain briefly again. You might have seen this chart before, how a regular mortgage works and how a reverse mortgage works with renewals and terms. So a regular mortgage traditionally is a 25-year amortization, and you can then break that down into interest rate terms. So you might have five-year terms, which is option one. So you might take a 5-year fixed rate and do that 5 times. At the end of that, you've paid off the mortgage. Your 25 years of having that mortgage are over. That means you would go through 5 renewals at the end of each term. Sorry, you go through 4 renewals at the end of each term because the 5th time you don't need to renew it. So that's what I mean by a renewal. A renewal happens when the interest rate term that you sign up for expires. And of course, you might have seen that you can get 1 year fixed rates, you can get 2 year fixed rates, you can get 5-year variable rates. These are all terms, and at the end of those terms, you have to then renew and you're offered a renewal rate. You can choose any pattern you like. You can take a 5-year, you can take a 3-year fixed rate, you can take a 2-year fixed rate, as long as for a regular mortgage, at the end of the day, you're going to keep doing this for 25 years until it's paid off. Reverse mortgages work a little bit differently, but also quite similarly. So there's still terms. You still can get 5-year fixed rates, 3-year fixed rate terms, but these terms just continue forever. There's no amortization. It doesn't last for 25 years. It continues for a lifetime, and essentially until both owners pass away, you will keep renewing into different terms. So hopefully you can already see this makes renewals for reverse mortgages and the renewal term you get much more important because potentially it's going to last for a lot longer and there's going to be more of them. I'm going to go into that in a little bit more detail, but what I want to talk about is the occurrence of renewal rates. So you get the upfront rate you sign up for a reverse mortgage. That might be 5-year fixed one time. So if you're offered the 1% reverse mortgage rate, I gave it as an example, you get that 1% rate one time for one term for 1 to 5 years, whatever the term was. So let's say it was a 5-year fixed rate at 1%. At the end of 5 years, that 1% expires and the lender will offer you a renewal rate that you can choose to accept or not, meaning that at the end of every term, you're going through this over and over again, possibly many more times, and you'll go through you'll pay the initial rates. Now, with a regular mortgage, you also go through many renewals as well. But unlike a reverse mortgage, these renewals eventually come to an end. As I showed you in the previous chart, they end when the mortgage is paid off, whereas a reverse mortgage is for life and is never paid off. And on top of that, in addition to this, one important factor is on each renewal, the balance you owe is smaller. Remember, for a regular mortgage, you're actually paying down the balance. So the real renewal rate technically matters less and less each time because you're only paying interest on a smaller and smaller balance each time you renew. And then finally, if you don't like the renewal rate offered by your lender, refinancing is fairly easy, certainly easier than a reverse mortgage with more lenders and options. There's probably 50 to 100 lenders, depending on where you are in Canada, and different options that you can approach to and different ways that you can go with if you don't like the renewal rate offered by your lender. With a reverse mortgage, you'll renew for life, and each time you renew to a new rate, the balance will be bigger. This is a super important point, and I can't emphasize enough. Unlike a regular mortgage, which is going down in size, a reverse mortgage is increasing in size, so the balance is bigger, so the renewal rate will be applied to a bigger balance, so it's much more important than the renewal rate on a regular mortgage. So not only do you only get that initial 1% rate that the lender offered that we use in this example in the first term, but you get the 1% rate on the balance when it's the lowest it will ever be. So the upfront rate you get on a reverse mortgage, whatever the first rate you sign up for, is the lowest balance of the reverse mortgage you'll ever have. That's why the upfront rate is arguably less important than all the other rates you'll pay in future on renewal. Finally, refinancing is much harder with a reverse mortgage. There are fewer options, there are fewer lenders, stricter penalty rules for breaking reverse mortgages because you can't break them the same way as regular mortgages. Make sure and check out my video on that. And also, there's the potential that you get stuck with a lender, which is what I want to talk about as another risk here. So what I mean by this is that you're unable to move to another lender. You kind of are stuck with that lender. And this can happen in regular mortgages too, essentially where maybe your income drops, so you get fired from your job, and now you don't qualify for a mortgage with a new lender. You end up stuck with the existing lender. What happens with a reverse mortgage? I'll give you a simple example here. Is let's say you take out a reverse mortgage for 55% of your home's value on a 5-year fixed rate. At renewal, at the end of the 5 years, with the interest and costs, the reverse mortgage is now 57% of your home's value. Now, many of you know that generally speaking, you can't get much more than 55% for a reverse mortgage. So that means you can't refinance that. You can't get 57% reverse mortgage. So what ends up is you kind of are stuck with this lender, and your choices are to try and get a regular mortgage to pay it off, which many of you won't be able to do at this point. You could sell your home, or you just keep renewing with the same lender. So that means you essentially have to accept what renewal rate they offer, and you're kind of stuck with that lender. Now, like I said, this can happen with regular mortgages too, but it's a much bigger risk with a reverse mortgage. So how do lenders decide on renewal rates, and what kind of renewal rates are you going to be offered? Well, they'll use market rates available. That's the good news for a reverse mortgage, but they'll often apply a premium on top of these at renewal. So if rates go down 1 or 2%, if you take out a 5-year fixed rate right now, and in 5 years' time, rates have dropped, you will get to take advantage of the drop, but that will depend on the lender. Some of them will apply premium on top of that. So what I mean by market rates are the going rates for a 1, 2, 3, 4, 5-year fixed rate or variable rate term at the time you renew. They can't gouge you, lenders. They couldn't say, I'm going to charge you 25% interest rate or something ridiculous like that. You're protected by various consumer laws, and also this would destroy the reputation of the lender. They just wouldn't get away with doing it for very long. However, they are legally able to apply a reasonable premium to the rate at renewal. And again, this happens in the regular mortgage world as well. And at present, this can be between 0 to 3% with the current lenders available for reverse mortgages in Canada. So with everything I've said, with this in mind, I strongly suggest you ask about renewal rates up front. And a better question than what's your rate, which is what most people ask for a reverse mortgage, is what's your renewal rate and how are they calculated? And like I just said, the renewal rate you're going to pay many more times on a bigger balance, and it might be harder to move to another lender. So it's very important that you consider renewal rate when making your decision. I would say more important than the upfront rate you're being offered. So another option is talk to a mortgage professional who's familiar with the lenders and how they renew their mortgages. They should be familiar with what kind of premiums they charge. For example, I know all the current lenders. I know what kind of renewal rates and premiums very well, and I use this to help recommend the right lenders to clients that ask me for advice or go through my assessments. So let's go back to the 1% example that I started off the video with and use some real life numbers. So let's say you're taking out a $200,000 reverse mortgage on your home, which is now worth $400,000, so 50% of the home's value. You've got two lenders. Lender A is offering you that amazing 1% fixed rate on a 1-year term. And lender B is offering you a 7% fixed rate on a 5-year term. That's an easy decision, right? 7 times higher. Well, let's take a look at the numbers. So what happens after the initial 1% term? Remember, the important question to ask is not what's your rate, but what are your renewal rates and how do you calculate your renewal rates? So the 1 year has now passed, that 1% rate is expired, and the market going rates for reverse mortgage are now 6% 1 year down the line. For example, that's the market of available 5-year fixed rate for reverse mortgage. But lender A tends to apply a premium, and they apply premiums at the higher end of the range. In this case, they apply 3% premium on renewal. So they're going to offer you a 9% 5-year fixed rate at renewal at the end of the first year when that 1% rate expires. So they take the going rate, the market rate, the 6%, and they apply a premium, in this case 3%, to get to 9%. Now, you're obviously not going to be super happy with that. Now your rate just went up 9 times. So you might be able to refinance to a different lender, but in this case, because you'd be breaking the reverse mortgage early, just 1 year in, you end up paying a penalty of $10,000. That's $10,000 on the $200,000 reverse mortgage, and that's pretty much in line with some of the penalties that you'll see with lenders at the 1 year point. And there's a whole video I have on that if you're interested in how penalties work. So here's what the numbers look like for lender A over 5 years, for example. So you pay 1% interest on the initial $200,000 for the first year, then 9% interest on roughly the $201,000 for the next 4 years, and then in total you end up paying about $82,000, or you don't pay, but $82,000 in interest is accumulated. Let's say your home has grown in value from 400,000 to 489. That's a 4% growth rate. That's fairly standard. At the end of 5 years, you have $207,000 equity in your home compared to the $200,000 you had at the beginning. So you've not done terribly. In this situation, the 4% growth of your home has offset the interest and your equity still increased. Let's take a look at lender B. So remember, they were offering a 7 times higher rate, 7% on $200,000 for 5 years. So over the first 5 years, your interest will come to a total of roughly $80,000. And as noted, let's assume your home has grown to $489,000. At the end of the year, 5 years, you now have $209,000 equity as compared to $200,000. So despite the appearance of the much higher initial rate of lender B, 7% versus 1%, you actually save $2,000 in interest in the first 5 years compared to lender A by taking out lender B's higher rate because of the renewal premiums charged by lender A. This assumes that there are no other costs and fees. I would imagine that the lender offering the 1% rate will probably throw in some other higher costs and fees as well, just to really up their return. And that's just comparing to the two lenders for the first 5 years. Now, what happens after that? So after 5 years, remember, lender A can keep applying a premium and they continue to renew your reverse mortgage at 3% premium to the market rates available, whereas lender B renews at market rates with no premium. So they just give you the going rate of reverse mortgage at whenever your term expires and they put you onto that. Over the course of 10 more years, this 3% premium ends up adding up to over $90,000 of additional interest that you pay lender A versus lender B. Because remember, every single year your reverse mortgage balance is growing and these premiums are now being applied to a higher and higher balance. It adds up over time, and yes, I put ouch. that can be quite painful, all because you jumped at this initial low rate offer and didn't think about what was going to happen at renewal and the renewal rates and premiums being charged by the lender. So that 1% rate that we talked about in the fake example here ends up costing you tens of thousands of dollars because of the renewal premiums. And this is a pretty, hopefully very clear example why renewal rates and premiums are so important, if not more important compared to the upfront rates. Now, the way I would put it is that this is an exaggerated version, since 1% rates don't and will never exist. But you can see even in a crazy exaggerated example, the 1% rate ends up worse off because of renewal rates for reverse mortgage. In reality, you never get a rate that's 1% versus 7%, a whopping 6% difference, or 7 times or 600%. Even with a 6% difference in this example I showed you, it was still better to take the higher rate because of renewal rates and premiums. Now imagine you took a rate that was just 0.1% different or 0.2% different, only to get hit by higher rates on renewal and higher renewal premiums. It would be a lot worse in this example. This example was made better by the fact that the rate was only 1% and was way lower. In reality, if the rates are closer, then you're actually going to end up getting hit even worse with these renewal rate premiums. So can't emphasize this enough. Renewal rate and premiums are incredibly important. Make sure and get some advice on renewal rates before you pick a lender for your reverse mortgage. So in summary, the initial rate for reverse mortgage is almost not important at all compared to the renewal rates and what you'll pay in the long term, in my opinion. I would make sure and consult a mortgage professional, ask questions, or do some research to find out what premiums lenders are charging on renewals for reverse mortgages. And ultimately, you need to think about the long-term rate you're going to pay over the life of the reverse mortgage and not get sucked in by what a lender is offering on a particular day and time and just simply choosing a lender because they have a slightly lower upfront initial rate. I hope this all makes sense. If you are interested in taking out reverse mortgage, I provide a free reverse mortgage assessment in 90 seconds, and I will look at renewal rates and I will make recommendations on lenders that have the best renewal rates and the best for your situation. And I'll also advise you if a reverse mortgage in general is a good solution or if something better works. It's a free 90-second assessment. All you need to do is click the link in the video notes or go to reversemortgagepros.ca/assessment. That's reversemortgagepros.ca/assessment. I hope this video made sense. If you've got any questions or comments, feel free to leave them below the video and I'm happy to answer all and every question that you may have when it comes to renewal rates and hidden costs and hidden renewal rate premiums that you might not know about when you're making your reverse mortgage decision. Thanks.